Numbers rarely shout, they whisper first.
The smartest teams learn to listen before the crisis speaks. Financial health isn't about reacting fast, it's about detecting early. In this episode, we'll uncover 10 early warning signals that your finance team must track to protect liquidity, profit, and credibility. Each signal tells a story, and once you know how to read them, you'll never be surprised by bad numbers again.
Strong revenue means nothing if cash flows the wrong way.
1. Negative or declining operating cash flow. When operating cash flow turns negative, it means your core business is consuming more cash than it generates. This often signals falling sales volumes, rising operating costs, slow collections from customers. Explain visually how persistent negative cash flow increases reliance on loans or credit lines, creating liquidity strain and debt risk. Emphasize that proactive collection, expense tracking, and cash forecasting can prevent this red flag from snowballing into a funding crisis.
Margins don't vanish overnight, they melt quietly.
2. Declining gross profit margin. A shrinking gross margin isn't just math, it's a signal of cost pressure or weak pricing power. Causes include higher raw material costs, intense price competition, or outdated pricing models. Explain that if this continues, it limits reinvestment and expansion. Recommend actions. Negotiate supplier terms, improve production efficiency, redefine value propositions.
Leverage can speed your growth or sink your ship.
3. Rising debt-to-equity ratio, D/E. When the D/E ratio climbs too high, your company relies heavily on borrowed funds instead of owned capital. That can magnify risk when interest rates rise or revenues fall. Discuss how this erodes investor confidence and limits flexibility. A healthy capital structure blends debt for growth with equity for stability.
Receivables tell time. The longer they wait, the more cash you lose.
4. Sudden increase in accounts receivable days, AR days. If customers take longer to pay, it points to weak credit control or financial stress among buyers. Long AR cycles choke cash reserves and force short-term borrowing. Recommendations. Review credit policies, monitor customer solvency, automate reminders and follow-ups. 5. Slower inventory turnover. Inventory that doesn't move is cash that doesn't work. When turnover slows, it may indicate overstocking, poor forecasting, or outdated products. Explain how this ties up capital, increases storage cost, and risks obsolescence. Encourage use of data-driven stock planning and real-time inventory dashboards.
Your credit rating isn't just a number, it's your organization's heartbeat.
6. Loan covenant breaches or credit downgrades. When covenants are breached or ratings fall, lenders lose confidence. Consequences include higher interest rates, restricted funding access, possible loan recalls. Reinforce the need for tight liquidity management, contract discipline, and early lender communication to rebuild trust. 7. Unexpected departure of key personnel. When senior finance or executive leaders leave abruptly, it often signals internal misalignment or looming instability. Such changes affect investor sentiment and operational continuity. Promote the idea of succession planning and transparent leadership culture to sustain confidence during transitions.
When accounting starts to look creative, the truth gets blurry.
8. Aggressive or unusual accounting practices. Sudden policy shifts, early revenue recognition, or delayed expenses may hint at earnings manipulation. Even if unintentional, it invites audits and reputation damage. Highlight that ethical reporting is not just compliance, it's strategy for investor trust. 9. Negative publicity, regulatory scrutiny, or legal action. Financial health is inseparable from reputation. Government audits, lawsuits, or viral rumors can hit valuations harder than numbers ever could. Encourage proactive risk communication and transparent disclosure to stabilize market confidence before speculation escalates.
Budgets don't fail in Excel, they fail in execution.
10. Significant deviations from budget or forecast. Consistent gaps between actual and forecast mean something deeper: weak planning, unrealistic targets, or execution gaps. Explain how integrating real-time variance dashboards and scenario modeling helps teams detect deviations early and course correct.
Early warning isn't prediction, it's awareness.
The best finance leaders don't wait for red ink. They build dashboards that alert them before trouble compounds. These 10 signals are not random, they interconnect. When margins tighten, receivables slow, and debt rises together, that's your alarm bell to act. Integrated dashboard view showing all 10 signals as green, yellow, red indicators.
If you want to master early detection before your next audit, subscribe and join me, Thanya,
where we turn financial noise into strategic foresight.